Akman. So many investors, rich and powerful, successful investors, use this strategy. I'm really excited to talk about this, and I'm sure you all are excited too. So before I start the Paytm Money, the topic of the day, long-term wealth creation through value investing, let me quickly tell you what the Paytm Money Talk is all about. So Paytm Money Talk is such a platform where we try new ideas, we discuss new strategies, and also we look at a new way of investing so that you can uplift your investing game. Here we invite somebody who has got decades of experience in managing funds or expert, and also we invite somebody from social media who has contributed tremendously and trained thousands of people, hundreds of people who have changed the way people need to understand or look at the whole investing game. So our endeavor is to consistently produce high quality content that can empower and enlighten you in your investment journey. So if you're someone looking for new investment opportunities, ideas, and want to diversify your portfolio, this episode is absolutely for you. So what we do here is that yes, today we have got two great speakers. In fact, all of you know them very well. So I'm very excited to start. So before I get into it, so let me introduce myself as well. I am Neeraj Gogoi, your host for this show today, and this talk is powered by Paytm Money. So, if you look at the investment world today, it's never been so complex as it is now. In one hand, we have got diverse products, we have got so many platforms. At the same time, the things happening all around the world, the inflation, the interest rate, the geopolitics, and in this whole jungle of financial products and the market, it is very important that we can give right direction to our new investors, traders, to take their investing game ahead. So to talk about that, I have got a great speaker, great personality. His name is Mr. Akshat Shrivastava, and I'm sure he does not need any introduction. All of you know him very well. He is a kind of a no-nonsense, straightforward speaker who speaks straight from his heart. He is a passionate teacher, management consultant, and also an entrepreneur. Over the years, he has taught into high school students, underprivileged students, and working professionals. His biggest pride is that several of his students are landed in world's leading universities, such as Harvard, Wharton, MIT, Columbia, and likes. On personal front, he loves to talk about food all day. So without wasting much time, let's welcome one and only Mr. Akshat Shrivastava. And in his own words, welcome to a very super duper exciting show. Akshat.
Hi, Neeraj. Thank you for having me. It's a pleasure speaking with you.
It's absolutely great delight to talk to you. In fact, I'm a big fan of yours. I'm
Thank you.
sure all our
Appreciate it.
audience participants, they know you very well. You don't need any introduction, but still would like to hear from you. How has been your investment journey? How has been your transformation? I'm sure you have been transforming a lot. People are inspired the way the kind of lessons that you give, the topics that you talk about. It's so inspirational. So here to start, would like to hear from you, your journey.
Sure. So, 3 points, right? So, first and foremost, I would say that I started investing because one needs to invest, right? That was the primary thing, that when you get any high-paying job, or for any matter for that job, you would have to invest. So that is reason one why you start investing. Point number two is that I started my journey like anyone else, right? I started with mutual funds, right? Then from there on, I learned a little bit more about stock markets. Then I got into direct equity investing. And from there on, I've been refining my style. I would consider myself to be a more macro investor, that I look at macros first, then business analysis. One of the reasons why I look at business analysis is because I've been trained as a management consultant. So we are taught how to analyze businesses. So I think these two would be my investing style, that looking at overall macros or macroeconomy, and plus amalgamating that with the business dynamics of things, and trying and staying invested for as long as possible. And if the fundamentals do not make sense, then do not be afraid of selling things or altering your portfolio. So this is how roughly I would define my investing style and my journey in investing.
Wonderful. In fact, Akshat, in last 2 3 years, we have seen lots of people have come to the market. So many
Yep.
of most of them are youngsters. In fact, 25, 30 years of old, and they are at loss, like how to start the investment journey.
Yep.
And choices are so many, and they tend to get confused. So, what
Yep.
is your advice? How do you want them, or how do you think they should start their first investment journey?
Right. So I would say a few points. So first and foremost, according to me, and I can be like, this is my investing style. Every investor would have their own investing style, and those investing styles would work differently for all sets of investors. So there is no one right methodology. For example, if you're listening to Mr. Ramdev Agrawal or Mr. Vijay Kedia, those two
Hmm.
have very different investing style, right? Similarly, if you listen to Mr. Warren Buffett or Mark Cuban, they have a very different investing style. So the point is that number one, you need to discover your investing style by learning from different investors. So that is tip one that I would say. Second thing, what I would say is that please understand the difference between investing and trading, right? Because
Absolutely.
when you are new to the market, people just confuse trading with investing. Those two are fundamentally very different things. Third and finally, what I would say is that if you are a retail investor who is just starting out, then word of caution would be that please start with blue chip equities, right? So that is where you should be doing if you are investing directly, and also build a little bit of holding power. So holding power simply means that, for example, please do not take a loan to invest in the stock market. Usually it is said that you should have a 2 to 3 year vision at the at the very least, right, in order to hold stocks, right? Because even if you check some of the blue chip companies in India right now, right, consider for example HDFC Bank, right, which is one of the most prominent banks in India. It has fallen from its peak by roughly 25% as of now, right? And if you lose faith on good stocks, and this is not a stock investing advice per se, I'm just picking it up as an example, that if you lose faith, you would lose faith simply because of the fact that you have no holding power, right? I mean, you need that money for immediate purpose, and you have put that in the stock market. Now you are expecting immediate return. So you are in essence trading without even realizing that you're trading, right? So please have a very clear differentiation between trading and investing. That is like the number one thing that I would say. If there is a place for you to get started, please understand the difference between trading and investing, and please understand what blue chip equity is. And finally, if you can learn a little bit about risk management, these two, three things I would say where you should get started.
Wonderful. In fact, the first section today here is what we call the market lens. That we are going to ask you, like, how do you think about the
Yep.
market? Of course, you can say that picking the bottom is absolutely impossible, right? But again,
Yep.
in
Mhm.
a complex situation like this, the market has been falling for last several months, and you see geopolitics, you see oil prices, the inflation rate, interest, and everything.
Yep.
What do you think
Mhm.
about? Do you think the bottom has been made, or what's your view on the market, Akshat?
Right. So I don't think that anyone can comment whether the bottom has been made or not. No one knows for sure. Right. That's the first thing. Everyone would be puntering, right? If I give my viewpoint that hey, bottom has been made, yeah, there is no head or leg to it, right? No one can guess it, right? So that's point one. Point two is that I know for a fact, if we look at like first principles way of thinking, that whenever you invest in a downward falling curve, you will make money, right? For example, if you would have invested when the markets were going down in 2020, you would have made money. If you would have invested in 2008 on a downward falling curve when the markets were falling, you would have made money. If you would go back to dot-com bubble, you would have made money in 2014, 2016 ish period, right, when there was US China trade war, markets were falling, again you would have made money. When there was European debt crisis issue, again you would have invested on a downward falling curve, you would have made money. So the bottom line is that if just take like a contrarian view, when everyone is scared, please invest. When everyone is like bullish, try to be a little bit cautious. At
Yes.
least do not invest in overinflated things. So that is what I would say, right? I mean, I would not. Macroeconomic issues keep on happening. It's not as if that you should worry too much. I don't think that any new thing has surfaced. There were a few concerns around inflation, Russia-Ukraine crisis, oil prices, and these have existed for the last several months. And according to me, all this information is now absorbed in the market to a very large extent.
It's great. Also, different investment strategies. Also, although you say that every falling market, when the market is a crisis in the market, that is a great best opportunity to buy the great companies, right? And you have given some example of some banks, right? And also, so what are the different investment strategies actually? This is again, if you can just tell our viewers what are the different investment strategies, their approaches, and what they need to do.
Right. So there are multiple investment strategies, right, which are used by different set of investors. Just to take you through a few, right, it does not mean that I necessarily use it, but just from a theoretical standpoint, first is buy and forget, right? So you just buy like good companies and forget about it. I don't know whether that's a good strategy or not. I
Something
can
like buy right and sit tight.
Yeah, so buy right and sit tight. But to what extent, right? I mean, that's the question that you need to ask. But that's a investment strategy that you simply buy and forget, right? Second would be something called as momentum investing, right? That hey, if these stocks are running, catch them and try to ride the wave, right? So it's essentially like surfing, right? So that's what momentum investing would be. Third would be value investing / deep value investing, right? So, for example, Mr. Mohinish Pabrai would be doing these type of investment. Fourth would be something like a Cathy Wood type of an investing, where you are purchasing high growth companies and playing the VC model, right? Buy like maybe 20 companies, right? Maybe 5 will survive. They will give you crazy gains. 15 will absolutely go to zero almost, right? So that is another strategy, right? So yeah, so these are like few thoughts, right? What I believe in is that just buy like good businesses, right, which makes sense as of now, right, which you feel are going to stay in the market for the at least 4 or 5 years, will maintain their competitive advantage. Invest in it when they are available at a decent price, right? Don't buy it at overinflated prices, right? And then sell it off when you feel that they have given a run up. How exactly to do it, it's a separate conversation altogether. But yeah, I mean, I am a more situational investor rather than saying and putting my style into one of these categories.
When the situation arises, right? Okay,
Yeah.
now today's topic is, of course, value investing.
Yeah.
So, what are the different steps? There are two things. First of all, how to choose a company. You have already given some examples. So, how to identify a company? What are the parameters that you are looking for to identify that company? And then next is deciding at what point that you are going to go ahead and buy it. And then, of
All
course,
right.
the third question, of course, again, exit.
Right. So I think if you speak now, there are different categories of value investing as per my understanding, right? But the overall sentiment around value investing is that you buy companies when they are available at a good price, right? So that's the bottom line, right? Some of the prominent investors, for example, Mr. Mohinish Pabrai is known for his deep value investing style, right? So he purchases companies when they are badly beaten down. This is the private
Mhm.
equity model that you are trying to execute in stock markets, right? So that is what value investing, according to my understanding, would be. Uh, Now comes the related question that can you really figure out the true value of a company? Very hard to do these days, because the rate at which money gets printed, the macroeconomic situations, to what extent the macros are impacted. If you consider the PE of India, of Indian equities, then the entire market in India still is, from a PE perspective, is highly overvalued, so to say, right? Still, even in this
Right.
situation, despite the crash.
Mhm.
So by that logic, you should not be buying anything in India, right? I mean, because it is not a value buy. But you will always identify these pockets of opportunities where you can go and invest. There is something called a sector rotation. So please learn a little bit more about it. That
Mhm.
sometimes the value is rotated out of one sector into another sector, right? A classic case in point would be auto sector, right? That you would see that if you consider, for example, Maruti stock, and if you compare the last 6-7 years performance, I don't think that it has even broken even, right? I mean, if you would have purchased Maruti at, let's say, X, then the price has remained stagnant for the last 5-7 years. So one could argue that it's a value buy, right? So you could consider buying these type of companies. Do I buy it? No, right? I mean, I'm more of a fundamental analyst, so to say. It's, if I see potential in the company, then I will buy it, right? So yeah, so from that particular perspective, I will say that there are different models of value investing, but in essence, fundamentally speaking, you are trying to buy a company at an inexpensive price. Now, those inexpensive prices can happen for a wide variety of reasons. One, the markets are getting crushed. For example, right now, a lot of companies are available at a discount, right? So they are available at value prices. Second could be that there is sector rotation that is happening. For example, auto sector has not performed well, right? Barring one or two companies in India. So it can happen due to that. And third is that, there is just like uh, a company has been beaten down quite badly, and there is a lot of steam still left in that company from this point on, right? So I think these would be the three reasons why you should be buying these companies.
Great. Now, from a retail, a new young investor point of view, right, who has come to the market last 2 years, of course, what you have said from lots of your experience, you have seen ups and downs, lots of cycles in the market, you have experienced it. So you can say it very confidently that this is how it's going to work. So
Yeah.
do you think that a new young investor, he should go out directly and start doing his own research, identifying his own stock, and then timing it or deciding when to buy? What do you think? Does he do it
But
on his own, or is it rely on somebody?
so it depends. It depends on a few things, right? So first and foremost, it depends on the time, right? If you're involved in a full-time job and if you don't have the time to sit and study, research, all that stuff, so you have no other option but to give your money to someone else, right? A mutual fund manager, most likely, in order to manage your money, and there is nothing wrong
Mhm.
with it, right? In India, mutual fund industry is very well regulated per se, right? So there is nothing off, and it stems from the fact that you have no time left to actually sort of work on your portfolio, right? So that's point one. Second point is around the expertise. That, do you know the basic concepts, right? I mean, if you're struggling in terms of understanding how a downward falling market works, if you start panicking every now and then, hey, you know what, market has fallen by like 2%, what should I be doing? You start panicking. So yeah, so please do not get into equities directly, or if you're getting it, then getting into equities, then do it in a smaller volume, right? And slowly build your position. And third is the experience, I would say, right? That the more you invest, it's a skill. You will get better at that skill with time. So yeah, so I mean, I think if you balance these three things out, then of course you can move more towards direct equity. So you could consider starting in mutual funds and then gradually graduate towards direct equity investment.
Right. And now, when you talk about value investing, there's again, you talked about growth investing as well. It's you have to, because
Yeah,
both of them are two very prominent style of investing. So,
yeah,
according to you, when we see there are so many investment mutual funds are there on the growth investing, growth fund, and growth investing front, but there are very few mutual funds on value investing. So, do
yeah.
you think that people slowly started recognizing that the value investing is even equally, or if not more, or how do you think attractiveness of value
Right.
investing is vis-a-vis growth
So very
investing?
quickly explaining the difference. So as we were speaking about value investing, it simply means that, what, buying stuff when they are discounted, right? So you're trying to
Right.
buy things cheap, right? So that's the goal. In growth
Mhm.
investing, you're not worried about the price, right? If you think that, what, HDFC Bank is going to double from this point in terms of its market cap, everything. So of course the stock price will also double. So if you either buy it at 1250 or 1350, it will hardly make a difference if you're keeping that perspective in mind. So that is called as growth investing versus value investing. Now, as far as what type of investing you should do, it really depends on what type of an investor you are, right? What philosophy you believe in. I'm a mix of both, right? I would say that you should not be an absolute um, uh, hell bent on one adopting one specific style per se, right? I mean, you should think a little bit, right? Do not buy things when they are highly overinflated, right? And do not buy things just because you are getting them at super inexpensive price, right? Now, because that thing can go to absolute zero as well, right? So from that perspective, be a little bit balanced. Mutual fund managers in both these areas would be doing a great job, right, in terms of identifying growth opportunities or value opportunities. So yeah, so that's what I would say.
Okay. Now, again, do you think value funds are less vulnerable in choppy market, or
Yeah.
more vulnerable from the vulnerability point of view?
Right. So they will be less choppy because if we let's work through an example. So for example, post 2020, a lot of money got printed. That money flew to growth stocks, and therefore you saw companies like Tesla, Zoom, UiPath, Amazon, tech stocks. In India, you had a lot of mid cap, small cap companies giving massive run ups during that time. And now, when the correction has started coming, right, the bubble size, it actually got shrunk, and what lost value the most, it were the growth stocks, so to say, right? So yes, in a choppy market, when the markets are going down, value stocks are likely to do better. So from that perspective, value investing will beat growth investing in a falling market.
Great. So good. Yeah. We got a fair idea about value investing, different kind of investing style. In fact, Akshat talked about his investment philosophy, his money philosophy. So I think let's hear something from the horse's mouth. We got a second speaker, second guest today here. His name is Mr. Sorbh Gupta. He is basically a chartered accountant and CFA by qualification. He is a fund manager for Quantum Long Term Equity Fund and Quantum Tax Saving Fund. With more than 18 years of experience in equity research as well as managing funds, Saurabh brings with him a wealth of experience of having tracked various sectors in his current and previous work assignment. So, welcome, Saurabh.
Yeah, hi Neeraj. Thanks for inviting us for this show. Thanks a lot. Yeah.
It's a great pleasure to have you today here. In fact, Akshat was giving lots of ideas about value investing, different investing style, and you have your own fund. You run a fund that's called Quantum Long Term Equity Value Fund, right? So, would like to hear from you the same things about the investment style. In fact, Akshat has got questions to ask you. He has got, So over to you, Saurav and Akshat.
Sure.
Yeah.
So should I go in and
Yes,
ask
yes.
Saurabh?
Please go ahead. Go ahead.
Sure,
Absolutely.
Akshat.
Yeah.
Please go ahead.
So sort of one of the key things that I keep getting asked from people who watch my videos is that in the US, a lot of migration has happened from like active mutual funds to passive mutual funds, right? So, and it has primarily happened because of the expense ratio associated with funds. So, where does your fund sit in, and what do you think about the expense ratio? Is it high? Is it low? So, if you can give some clarity around that.
Yeah, sure. Yes, expense ratio is something where people are recognizing that fact that expense ratios are important. Maybe 5 6 years prior to where we are right now, people did not focus on the expense ratios, but this is getting more and more important. So right from the inception, we started as direct to investors. So we did not have a regular plan for a long period of time, and we were one of the most cost-efficient mutual funds available at that point in time. This was much before SEBI forced the industry to have a separate direct or regular plan. And even now, SEBI has a roadmap to, as your AM increases, you have to reduce your expense ratios. Even before it became mandated, 5 years before that, we had a clear mandate that how our expense ratios would move as our AUM increases. So clearly, we believe that this is an important aspect. And now, all our presentations, we say that our expense ratios will come down as the AUM increases. We are one of the most competitive in terms of we recently, about 3 years ago, when we launched the regular plan, we are the most competitive. But even on the direct side, we are very, very efficient in terms of our expense ratios when we look at the peers.
Sure, absolutely. So that makes sense. Now, if you could tell a little bit more about the audiences who have joined us, about the salient features of the firm and of the fund, and what are some of the key points that you would want them to understand if they are considering investing in this fund?
Sure. So, Quantum Long Term Equity Value Fund was launched in 2006. So, we have over 15 years of track record now as value managers. If you move to the next slide, I'll just introduce a few points over here. Can you move to the slide? Yeah. So, close to 15 years of track record. We follow the value investing tenets. One of the first ones to openly say that we follow value investing. Aims to deliver long-term risk-adjusted returns. So we are not trying to be myopic in the markets. We try to take a longer-term call with detailed research done on stocks, buying stocks at below intrinsic value, and One traits of value funds, as Akshat was also talking about, is that we're trying to protect the downside of a portfolio when the markets are down. So that's a trait of the portfolio. And when we select stocks or companies, this is one thing that is very, very important to us as well. Can we move to the next slide, please? Yeah, so I'll just take you through the three guardrails that are the most important when we identify companies for the fund. Is one is the liquidity factor. So we have a minimum liquidity thresholds because we believe that what we need to give in terms of NAV to our investors is a real NAV. Because in case of high redemptions and the markets are down, if we own illiquid stocks, the stocks will fall when people want to redeem. So that's the reason we only choose very liquid names. So our minimum threshold is $1 million daily trade in any stock for it to become part of our universe. That's the first guardrail. Second, very, very strong on corporate governance. So we just avoid any companies who have shortchanged the minority investors or is in close hands and gloves with the government or have crony capital kind of business models. So that's also totally no. And being value managers, valuations are important to us. We are not trying to buy cheap companies, but we are trying to buy companies which are available at below intrinsic value, but have a very well defined timeline catalyst to play out where we'll achieve the intrinsic value of those businesses. So these are the three broad guardrails that we follow when we look at stocks for the portfolio. Can you
Understood.
move to the next slide? Yeah. So I'll just talk about what's our current portfolio positioning. We believe that we are amidst a cyclical recovery in the economy, and we have when we look at different sectors, we clearly see value emerging in auto sector. It's a consumer discretionary sector where we believe there is a clear value, where the stocks are very, very attractively valued with great balance sheet, great ROE. And as business cycles pick up, those companies should do well. Again, we are also very, very bullish on banking. Banking is offering very, very good upsides in our portfolio. We have a strong weight on banking. What we believe is that if you look at balance sheets of some of the banks that we own, they are one of the best capitalized in 10 years. They have the lowest credit to deposit ratios. The credit costs are one of the lowest in last 10 years. So great opportunity to create wealth in the banking sector, and some of the stocks are really trading at good discount to intrinsic value. So great opportunities lies there, and they are active part of the portfolio. Again, information technology, which is IT services, which we trimmed last year because of higher valuations. We have been adding them again. We believe there is a good growth available in these companies, and they've again become attractive. So they are again a good part of the portfolio. And there is a decent size of the portfolio into building materials and utilities, where we believe they will benefit from the economic revival of the economy. So that's the portfolio position. Again, the sector allocation is not on a top-down basis. We are a bottom-up research person with a 14-member team. So this is the portfolio, the sector allocation that you see is a byproduct of where we are seeing value and a catalyst. So our portfolio positioning is based upon what upsides do we see and how stock companies are trading below fair value. So this is how the sector positioning is there right now. Next slide, please. Again, people do ask that how is the portfolio positioned in this higher interest rate environment. So people need to be careful about two things, and in our portfolio also we are being careful about two things when the interest rates rise. One is the impact of the higher interest rates on the balance sheets of the companies that we own, investee companies, because as interest rates go up, if the companies are higher leverage or they are running high debt, they tend to have lower profitability because interest costs will go up. Even they could suffer more damage because of higher interest costs. So when we test check or stress test our portfolio, close to 8 companies are financials which are very well capitalized, and of the 30 companies that we own in the portfolio, 13 are net cash companies. They do not have any debt in the portfolio. Similarly, 7 companies are with debt to equity less than 0.4, so very manageable. And there are only 2 companies which have relatively higher debt, but then again, they are utility companies with fixed regulatory ROE that they get. So we are not worried about their balance sheets as well. So very strong in terms of balance sheets. That's the first thing that we have to be very careful in this environment, and we have been stress testing our portfolio for that. Next slide. And the second aspect, which becomes extremely important, is the valuations. Now, over the last decade, if I can say so, there has been cheap money that has been floating around in the world, financial world, and that has resulted in companies being trading at exorbitant valuations of 70 times, 80 times. As the interest rates rise globally, what happens is that these PE multiples will shrink because the cost of capital is going up. And we have been very, very careful on creating the portfolio. Being value managers, that also helps, but we are much discount. Our portfolio is at a very deep discount to what the Sensex is. So our portfolio trades at close to 13 times in terms of PE multiples 1 year forward, vis-a-vis if you look at the Sensex, which is at 20 times. So through our stock selection process, detailed research, we have been able to curate a portfolio in a kind of a frothy market, which are very, very attractive. And when the interest rates rise, these valuations will be here to stay. So we are not owning very highly valued companies, which will suffer the most as the interest rates go up. So portfolio positioning is taking care of two things: strong balance sheets and great valuations. Next slide, please. So as I was explaining that in the rising interest rate environment, there will be two impacts on your portfolio. One is the valuations. Valuations will compress. Higher the valuation, more the compression risk. And profitability can come under pressure if the balance sheet is under debt, because there will be interest cost on the P&L. Both these aspects have been taken care in our portfolio, and even to the listeners, I think people should be careful about these two aspects as they look at investing. Next slide, please. So, in terms of the debate that Neeraj initiated on value over growth, no, people think that when the growth picks up in the global economy or in India, growth stocks do well and value does not do well. Now, that is not true. It's actually contrary. Whenever there is a good, strong growth globally, what happens is a lot of companies do well and a lot of catalysts start to play out across the sector. To give you an example, between 2016 to 2019, when India's GDP growth was falling, there were only few companies which were doing very well, and because the cost of capital was low and there was a lot of liquidity, just few stocks did well because a lot of liquidity were chasing those few names which were growing, and rest of the companies were not growing. The situation seems to be totally changed now, where there is a broad-based recovery where many companies are doing well and the cost of capital is rising. This is the perfect environment for value investing. So this is a very similar period with what we saw between 2003 to 2010, where value did very well over growth because the cost of capital was higher and the growth was good globally and in India. Similar environment right now, after 2021, what we are seeing is that the growth is picking up in the economy. Companies are reporting good numbers. Corporate earning is on an upcycle, and interest rates or the cost of capital is going up. So environment is very, very conducive for value style of investing, and it's making a strong comeback. And we believe this will continue. Next slide, please. So this has been the fund's track record since inception. We have outperformed our benchmarks, which is BSE 500, BSE 200, Tier 1 and Tier 2 benchmarks. There have been performance lags between 2016 to 2019 period. The reason being that value was not doing well, and when the style does not do well, the fund manager has only two choices. One is he does a style drift, where he tries to choose growth stocks without telling the investors and try to maintain the performance, or he is candid enough to talk about the underperformance and tell the reasons of underperformance, that there is a global kind of underperformance by value managers because the value stocks are not doing well despite great value in them. We've been doing that. We have been explaining that. Thankfully, that times have passed. We've survived those times, and things are looking much, much better for value investing. And we believe there is a strong catch-up that will happen on the value style vis-a-vis the growth style from here on. Maybe we can stop here, and then we can take up questions with Akshat or Neeraj might have, or the listeners might have.
Yes. Akshat, again, there's a question for you. There are two basic questions again. I think we should, there are lots of young people who have joined in. They said, how long one should hold a value fund? If you're investing in this fund, what is the duration? How long, keeping in mind?
Look, to start with, you should have a minimum. I can give you a minimum time horizon. That should be 3 years, right? That should be any equity investment should be with a view of 3 years, and that is also true for value funds. From a longer term perspective, then your allocation towards equity, which includes your value fund allocation, should be depending upon your financial goals. So longer the better. Now I'll give you an example, not specific to value funds, but specific to the markets, that if you are owning any stock if you're owning Sensex for more than 7 years from any point in time in history when Sensex started in 1980, you've never lost money, right? If you have hold it for more than 5 years, it's 92% of the times you will not lose money. And if you're holding it for more than 3 years, close to 80% time you will not lose money. Right? So equity is a long-term game. Same for value managers. There will be cycles where there will be an underperformance, but there will be cycles where there will be a catch-up. We have seen those cycles in the last 15 years. So minimum 3 years and longer the better would be my answer.
Yes, Akshat.
Yeah. So the same question for me, or should I be asking Saurabh some questions on the fund itself?
Yeah, you can go ahead. In fact, okay, let me ask one question to Saurabh. I think your stock picking style is bottom up, right? So, what is that? Why bottom up approach, and how it is better than top down for your style of investing for your fund?
Sure. So let me, for the benefit of the listeners, let me tell you what is bottom up and what is top
Yes.
down. So top down is identifying an opportunity in terms of sectors which is growing. For example, sitting here, I believe that India's road sector will grow, and I'll take two companies without looking at those companies in terms of balance sheet or all. Maybe two largest companies, I'll go ahead and invest. That's a typical simple example of growth investing. From a bottom up perspective, what happens is it's more kind of looking at the company, looking at the annual report, looking at the cash flows, and then looking at the opportunity size, whether that company has the right to gain market share or gain its generate revenues. Does it have a right to gain profitability and do business, right? So that's the bottom up. From our perspective, the important philosophy, as I told you, one of the guardrails is corporate governance in India, because we are still a developing democracy and our legislations and regulations are not so strong. There are enough rogue companies in India where when we are looking at investing who are trying to fleece the investors through wrong data points and other aspects. Right. So very simply, see in India, when you are investing, you have to be careful whom you handshakes with. If you shaking your hand and you get your five fingers back, then it is good. Most of the time, you might not get your five fingers back. So it's very important to do your bottom-up research, understand company, meet the managements, and then put in your hard-earned money into those companies instead of taking a top-down approach where you can be cheated by a lot of companies. So there have been a lot of
Mm-hmm.
examples of fly-by-night companies. Classic example is education sector in India. If you go back 7, 8, 10 years, from a top-down perspective, great opportunity size. India has a big population who would like to get educated, higher education or online education. And I can tell you many examples where companies did not even survive. From a bottom-up perspective, we never invested on those companies, and most of these companies are bankrupt or have taken away people's money. So we believe from a bottom-up perspective, things become very important for a value manager to look into the aspects of cash flow generation, the management quality, and other aspects. So bottom-up is more important than top-down from a value investing perspective.
Great. Now, we are again Akshat, if you see, we are kind of a rising interest rate kind of a scenario. It just started interest rate cycle. So, how does it make sense for value investing in this kind of a system, in this kind of a scenario?
Right. So, Neeraj, I think it would be incorrect on my part to sort of plug everything as value investing, because I'm sure that Saurabh can comment more, that there would be
Yeah.
different styles of value investing also, right? I mean, there is no one set format of value investing, right? So my understanding of value investing might be very different from what Saurabh is trying to execute per se, right? So my understanding would be that first and foremost, these stock markets are forward-looking creatures, right? So they would have already figured out that interest rates are going to rise, right? So that has been factored into the economy as per my thesis, which means that we are already preparing for it, which also means that if I have to take a contrarian bet, then my idea would be to pick companies that are undervalued. So I would not get into the debate versus of like value plus and or growth, right? They might fit the value investing criteria that Saurabh is laying out, They might also fit the criteria, because I was looking at the fund and some of the companies might typically fit a growth investors portfolio also. So Saurabh can correct me there. So from that particular perspective, I would say that you are right that interest rates are going up. Theoretically, value investing companies should be doing well now, but I would be taking a contrarian view, because I believe that the governments have enough incentive to create or keep creating growth. So in such an environment, I'm bullish about sectors like tech, finance, banking. I keep speaking very highly about, and these are same sectors that Saurabh was also speaking, that he trimmed down his position on tech stocks, and I did the same, right? That in India, that I literally like purchased one of my first tech stocks in India in this market now, right? Before that, I was not holding even one single tech stock. So I think it's highly situational game. Value investing is slightly broad term, right, per se. But the idea is that in a in a rising interest rate environment, it does create a lot of opportunities for you to go and pick good companies that are trading at a discount. So that is what every investor should be doing.
Okay. Now, there are a few questions. In fact, request all the participants, all the viewers to ask questions if you have any for both Saurav and Akshat. So there's a question here from Sefali Singh. What she is asking is, isn't the value underlying philosophy of every fund is to buy undervalued stock? And then why to promote fund as a value investing fund? Because every fund has got a philosophy of buying undervalued funds. So why to mark a fund as a value fund?
Yeah. Is that question to me? Should I answer?
Yes, 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 please.
Yeah. So Neeraj, nice question from Shifali. But before that, I'll just like to answer the point that Akshat raised about our position in the stocks, which
Oh, yeah.
appear to be growth. So look, one big misnomer on value investing is that value managers are not looking at growing companies. That's not true. It's that value managers are looking at companies at their price, and they want to pay their own price, right? They want to own growth companies, but not at the premium which the market is maybe assigning to that growth. So growth premium we don't want to give. And as Akshat rightly put out, these kind of environments where rising interest rates, some of these growth companies get a hammering, and we can get some great companies at below intrinsic value, and we can create a strong portfolio from a value investment perspective. So value does not mean cheap. So there is a difference. So that's the first point. On Shefali's answer that are all funds or all styles looking at undervalued companies? That's not true. Look, there is always an intrinsic value, which is the fair value of companies. Like so, for example, any value managers will try to have a margin of safety and like to invest in below that intrinsic value. For a growth manager, the underlying thought process is that I can buy that stock at intrinsic or maybe above intrinsic, but the higher growth will ensure that I make my returns, right? That's the underlying philosophy. So one philosophy is quality at any price. Because it is quality, it will never trade cheap, and I need to buy it. And because it's quality, it will continue to do well, and it will generate returns for investors. From a value investment perspective, it's a great company, right? But I think it's investing is all about futures, and there will be multiple things which could go wrong in future. I will wait for my price, and maybe 25-30% this below intrinsic value whenever I get, because of market corrections or myopic correction in the stock because of a bad quarter. That's my opportunity to buy the same name, right? So I'll stick to my price. In that, there could be errors of omission where I could miss stocks, but then that's the discipline that we need to have, and those disciplines protect us in a down market.
Cool. There's a question from Rupali Gade. So this question I will direct to Akshat. Um, Again, it's a very basic question. Is investing compulsory? Why should one opt for long-term investment?
So is investing compulsory? It's not
Yes.
compulsory. It's not as if that you'll be penalized by someone if you don't invest per se, but you would suffer a lot of financial damage if you don't invest. A classic case in point is, and I can give a few examples, right? So first and foremost, if you consider our parents' generation, or like my parents' generation, right? What would usually be the investment opportunity would be go invest in real estate or go do fixed deposit. They were still giving good returns. But as of now, the markets have become very choppy. And if you look at the fixed deposit real returns, the situation is such that inflation in the economy in India right now is roughly 8%. FD rates are 5 to 6%, depending on the bank where you are investing your or putting your money. Then in real terms, your 100 rupees in a bank, if you do a fixed deposit, it becomes 98 rupees. So you're definitely losing money if you're not investing. Second key point is that investing by theory means that you're taking risk with your money. You are putting it right in risky assets, for example, equities, with the hope of making returns. Third related point is that if, as Saurabh was saying, that if you would have invested in Nifty, right, or variant of Nifty, you would not have lost money. In fact, you would have made returns if you held your position from a long term perspective. So, yes, you should invest if you don't want to lose money. And yes, you should invest in the long term because it helps you generate wealth. And equities have been a proven instrument of building wealth. And final point is that India is a fairly new market when it comes to equity investing, right? I mean, it might look really an odd statement, but honestly, we are not that old, right? I mean, if you think about it, that equity investing really picked up from maybe like mid 90s onward, right? So it's not that old a thing in India as of now. So think about it that in our lifespan only, right? I mean, if we continue to invest for 40, 50 more years, right? I mean, we would have invested in major part of the Nifty's history, right? So from that angle, so yeah, there is like a lot of wealth to be built if you think from a long term perspective.
So investing is a master. So all of, yes, definitely. Now, second is again for sort of like again with respect to market volatility. Again, Kunal is asking this question. Like we have been seeing lots of volatility of late. So how long this volatility is likely to continue?
Look, equities by nature are volatile, right? So volatility will always be there, right? And that's their nature, and that's why you generate superior returns, because volatility is equal to risk, as per people think. But we think that loss of capital is a bigger risk, but that's a separate discussion. So volatility, why is the volatility? Markets become volatile when there is more uncertainty, opaqueness. Markets do not like opaqueness. As of now, as we stand today, there is opaqueness on what is happening in a geopolitical crisis between maybe NATO or Europe or whatever, and a fallout of that is what is happening to inflation, because there will be problems of crude and other aspects. So there is one set of uncertainty. Second set of uncertainty is rising interest rates globally after 10 years, right? So the low interest rate environment has been for 7, 8, 10 years post GFC. Materially, the interest rates did not rise in the Western world. So maybe that kind of interest rates and that kind of inflations that they are facing, it's the first time maybe in the lifetime people are facing that. So anybody who is 40-year-old have never seen an 8% CPI in their life in US, right? Where it's a very different case in India, right? So that's the reason that we believe that maybe US investors or FPIs are panicking about a bit more than Indian investors, and that you can see in the flows. We have about
Right.
$28 billion going out, right? So once these uncertainties start to tame down or get totally factored in terms of either market corrections or maybe earning volatility coming to an end, where market believe, okay, corporate earnings will not get impacted because of this volatility, or the market corrects enough where it becomes attractive enough, we believe that volatility will continue. So that's the reason. Once the market fathoms and understands this risk and price this risk, the volatility will end.
Okay, again, next question is for you only, Saurabh. It's a Vernon Fernandez. He's asking that question. Any equity investment needs 3 years of gestation period. How is this fund different from other funds?
Yes. So one is value. I think we have talked a lot about value. Another aspect is when we say that people should be invested for 3 years, and we believe that people should be invested for long term. Am I, as a fund manager, doing the same? Is the question that the investor should ask the fund manager or the fund management team. Right?
Hmm.
So how will you get an answer? You'll get an answer from the churn ratio or the turnover ratio, right? So if you look at funds, quantum long-term equity values, long-term churn ratio, it's close to 20%, right? So once the stock is coming into my portfolio, it stays there for 5 years, right? So if I am preaching long-term investing for our investors, I am also following the same, where I identify companies, I put them in the portfolio, I continue to track them, meet them, and ensure that they are doing what they're supposed to do. But I am looking at a longer-term perspective. So we believe that that philosophy of ours matches. We're trying to match that with investors' philosophy, and we are preaching what we are doing. So that's broad difference. If you look at some of the portfolio companies or some of the funds who have long term in their name, but their turnover ratios are close to 200%. Right, the portfolio is changing 2 times in 1 year. So
Right.
they are essentially, are they long term, or they want investors to be long term in their fund, is the question that needs to be asked.
Okay. I think again, this time for Akshat, there's a question from Sandeep. Current scenario, mutual fund lump sum or stocks? Which one would you prefer for 3 to 4 years perspective?
Depends, right? I mean, depends on your skill set, how much time you can invest, right? As it's more of a question that, hey, should you be, number one, should you be taking advantage of the current market fall? The answer is yes, you should be investing, because when you invest in the downward moving cycle, that is when you make the most amount of returns, mathematically speaking. Second, should you go via the mutual fund route or should you go by the stock market route? It really depends on how much time can you dedicate in terms of researching the stocks, keeping track of it. If you are in a full-time job, you just don't have the time to research, stay updated, make moves, then probably makes sense to just do mutual fund investing. If you are slightly more nuanced, then investing in the stock market, direct equity investing might make more sense, provided you can hedge risk, right? And provided you have the time to upkeep with your portfolio. So that's what I would say, right? I mean, and but yeah, please do invest. It's a wonderful time from investing viewpoint. Please do not get panicked, because right now, if you look at the sentiments, it's very negative. That, hey, you know what, everything Nifty is going to absolute zero. So that is the entire narrative that is being built, and Nifty has not gone to zero, and it never will, right? From that perspective.
Cool. Again, Anirban, this is again for Akshat. You, Anirban is asking this. Uh, Again, small cap, large cap, mid cap. Is there any choice with respect to market cap point of view?
No, so I don't think that is. I would not say there are a lot of large cap companies that are available at a wonderful price. There are a lot of mid cap and small cap companies that are available at a wonderful price. So opportunities are there everywhere. A related point here is that I think personally, right, from a mid cap and small cap correction perspective, the correction started even before November 2021 in mid cap, small cap. It came into large cap subsequently. So according to me, small cap and mid cap have corrected even more, right, from that perspective, and which is obvious, because in a downward falling scenario, mid cap and small cap stocks are going to correct more. So probably more value there, right? Saurabh can chip in and explain more. That's point one. Point two is that there are what what needs to happen is that it should fit with your portfolio. It should not be that if you're creating your own portfolio, then you have just purchased everything small cap, right? And you have created a highly risky portfolio without even realizing it. So please don't make that mistake. Please understand that every stock that you're purchasing, it should align with the portfolio that you're designing for yourself, and it meets your meets the risk that you're comfortable taking. Otherwise, then people worry about that, you know what, markets are very volatile. It might be the case, but also your portfolio might become very volatile if you just end up purchasing all small cap and mid cap stocks.
True. Again, before I am, there are two very important questions that we'll take. And again, for sort of, Anjali is asking this question: how long this fund is appropriate?
Yeah, as I highlighted, this is a fund which should be an anchor fund in your portfolio of mutual funds, and value fund are for longer terms, minimum 3 years, and then you anchor it to your financial goals. So maybe 10 years down the line, you want money for your maybe retirement or your kids' education or those aspects. With lower volatility compared to the markets, this could be your anchor fund for more than 3 years view, where you can put some money and build around you need to diversify across styles, that's for sure. So we'll not advise you to invest 100% in a value fund and then sit back, because there are times where value will not do well and there will be times where growth will not do well. So you have to have a mix and match approach, minimum 3 years, and then anchor the allocation to your financial
Mhm.
goals. Because you need to beat inflation, you need that growth in the portfolio to beat inflation and achieve your financial goals. So, and this could be an anchor fund for that.
Yeah, I think we had a fantastic discussion today. I think viewers, they have learned a lot about investment philosophies and the approach and why you should invest and all these things. So, viewers, if you have got any more questions, we have got some more time left. Please feel free, go ahead and type your question in the chat box. And again, we'll start final comments, final about your views, about your advice to our viewers. And also, please recommend some books. In fact, Harit has been requesting again and again. Can you request Saurav and Akshat to recommend some books for reading? So please go ahead with the final comments and suggest some books.
All right, so I'll go
Saurav,
first.
yeah, yeah,
Yeah.
sure.
Okay, okay, all right. So Arith, basically what I would say is that read a range of books. Stock market is not just about learning about stock markets. It also has to do with a lot of different things. It obviously is contingent upon the fact that what is it that you're trying to do in the stock market. If you want to trade, then read trading oriented books. If you want to develop business understanding, then a lot of things. I think articles these days are very good, right? So for example, there are a lot of insightful articles that are written on McKinsey Quarterly, BCG Insight. So start there. These are consulting firm oriented articles. They give a entire overview. So that is where I would advise you to start. Very easy to read. Then go to a range of books that you can read. So read like economics related books. One of my favorite would be Undercover Economist, right? So read that. That's a wonderful book. You will learn a lot of economics from it. On top of that, I would not say like, I mean, read like very hefty books. Read the books that you enjoy, right? So yeah, read wide variety of genres, read articles, and read books that you enjoy. So you will retain more.
Great. Saurav?
Yeah, so in terms of the key takeaways that you can have is that one, you have to anchor your thoughts for a bit more longer term, and that's why this thing I'm saying repeatedly, because what I'm seeing is that a lot of investors who have come in the markets have come in 2, 3, 4 years, and when things have been going very good for the equity markets, right? But things can be a little tough for some time. So anchor your thoughts to a bit more longer term, and that will help you achieve that wealth creation that you are looking for. Because in the near term, markets will be volatile. It will behave like a voting machine, as Warren Buffett famously said, and in the longer term, it will behave like a weighing machine. So you need to focus and treat equity markets as an asset class and not as a speculative play like some other or online apps that you have in the markets. So equity is a serious game. That's one. From a books perspective, as Akshat highlighted, there are enough good articles now available that you can read and understand about different styles of investing. For a starter on a value fund, newsletters from Berkshire Hathaway, easily available on the web, free. You can go through, read them. Mr. Buffett explains value investing and investing in very, very simple terms and with very great examples. So you can go through that. One good book that you could read is One Up on Wall Street. I think it's a very breezy book, not with lot of numbers, valuations, formulas, but a very breezy way of looking at investments. That's one book to start with, so that you don't feel boring, because contrary to expectation, investing is a very boring activity. You need to go through a lot of data, a lot of annual reports and those aspects, and it to understand numbers and other things. It's not that exciting as it appears. So it's a boring activity. So starting point should be these two, and then as you feel more interested, you can just then further decide on what do you want to read and to understand a little more from a technical
Wonderful.
perspective.
Wonderful. I think we had a wonderful discussion today, and our viewers have learned a lot about different why one should this particular value investing value fund could be a core portfolio of one's long term perspective, and why investing is so important. India is a growing country, and I think it is a best opportunity, and particularly people who started working right now or recently, I think they had a fantastic time ahead of them to create your wealth. And with that, I would like to thank both of you, Akshat and Saurav. It's a wonderful talking to both of you, and looking forward to see you again in our shows. And thank you so much, gentlemen.
Thank you.
Thank you. Thank you.
Thank you so much. And also like to thank all the viewers who have participated from across the different channels. Thank you. Keep participating, and we'll try our best to bring in new topics, new speakers, so that we can give you insight on different topics, and you can, improve your investment game, if I can call it as a game. Thank you so much, guys. Thank you.
Thank you.
Thank you.